Hello, everyone. Today on the final bar, we're going to talk about the market continuing to push higher. That S&P 3000 level is so important. On Friday, felt that weakness going into the later half of the day, wondering how 3000 was going to come into play this week. But Monday all of a sudden goes pretty strong. Interesting, though, to see the leadership with tech and healthcare at the bottom. So we're going to dig into the market from the top level down, the bottom level up, sectors in the middle. Ladies and gentlemen, this is the final bar. Good afternoon, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the technical action of the day, look at the charts together, and try to understand how today's action fits into the big picture. And, you know, our cup runneth over with potential catalysts, and especially non-financial catalysts. Obviously, we're in a very volatile period for so many different reasons, a lot of unrest here in the United States. In a lot of areas, a lot of uncertainty. So what, my goal is with this show is obviously help you build a better routine for understanding the market from a technical perspective. Use that along with all the other inputs that you're gathering, and just try to help, a good momentum, good trend following approach be a part of your overall process. And so, what we're going to do today is focus on this evolution of the S&P, how we continue to see strength, but there are a lot of question marks in terms of the rotation of sectors, in terms of leadership, in terms of asset allocation, a lot of different themes that we're going to pick out today. Now, it's not just me that's going to help you. We have a lot of great guests that we've brought on. Our last couple of weeks, we've had just a fantastic slate of guests to come on, and it's going to just keep getting better, I think. Tomorrow on June 2nd, we have Peter Brandt joining us. On June 3rd, we have Frank Capilleri. He's the Instinet technical analyst. Next week, we'll switch to some more money managers. We have Dana Lyons joining us on June 9th, and on June 10th, Mark Ungewitter. If you missed it earlier today, we had our Behind the Charts episode featuring Ralph Acampora. Behind the Charts is an interview-style show where we sit down with prominent technicians, money managers, strategists, and learn about how they developed their toolkit, how they learned about technical analysis, how they approach the markets, what it's telling them about the current environment. And we had a great opportunity to sit down with Ralph a number of months ago. It was actually just before the Christmas holiday, and it was a great discussion about him applying and learning technical analysis in the 1960s and 70s. And I tell you what, very interesting to hear how he learned then versus a lot of the things we're seeing now in terms of the uncertainty, a lot of the volatility, and so forth. I want to go on to our market recap. Before we start, though, as a reminder, we have polls running on our StockCharts TV page. So if you go to StockCharts.com/TV on the right side, we usually will have a poll going. It's a great opportunity to just weigh in, see what other viewers are thinking about different market-related things, industry-related ideas, and also gives us a chance to make the show pretty interactive. And one of the questions we asked you into last week was, if you could pick one chart to watch right now to get a better feel for the overall market environment, what would you choose? And we gave you 5 choices. Different markets, and it was actually pretty nicely spread around them, but in order of popular answers, almost a third of you said semiconductors. Think the SOX index or the SMH for that. The 10-year interest rate, 29%, is almost the same amount, so looking at the 10-year treasury yield. Next after that was gold with 17%, Microsoft with 13%, home builders for 10%. So, it's an interesting take. I hopefully if you've seen this show, you've seen how I talk about semiconductors being a good macro read, because that's a group that tends to do well when the market's doing well. If you can get a good read on semiconductors, usually in good shape in terms of the overall market direction. But right now, and that's why I kind of was interested to see what people would say between semiconductors and Microsoft, both in the technology space. That's 44% of you, almost half. But there are a lot of other assets that I think provide some interesting clues. The 10-year yield's a really interesting one. And last week, with a couple of my guests, we dug into to 10-year yields a little bit. Katie Stockton comes to mind. We're looking at the 10-year together at a potential inflection point turning higher. The TLT has been such a strong relative performer relative to stocks, but that performance has rolled over as stocks have continued to appreciate, the TLT testing moving averages. So I think that rotation away from bonds would be an interesting theme that would be different than what we've seen for quite a while. Gold is a funny one, and as much as I love to think of gold as a great read on the safe haven trade, it's moved together with stocks as much as it's moved separately from stocks. And jumping to the market recap, you'll see what I mean. Today, the S&P finished around 3055. That's up 0.38%, so just over a third of a percent higher. Mid caps and small caps up even more. So the small cap index, the S&P 600, up almost 1% to 811. The VIX a little bit higher to 28.26. As we go to the bond markets, you can see that the TLT actually came off. So, while stocks sort of, pushed higher through the day, the TLT actually started much lower, gap down out of the open, but finished more toward the highs of the day, which is, encouraging in terms of the short-term demand. But overall, again, down from Friday's close. The dollar's weaker, and just to fast forward to one of our 3 and 3, it's going to feature, actually 2 of them are going to be related to the dollar today. In terms of commodities, gold up. So here you have the situation with stocks finishing pretty strong, gold actually leading the way higher as well, up 0.5%. It finished near the high. So, again, I think a lot of times we love to oversimplify. I think, all right, if stocks are up, gold's down, bonds are down, and you just have these different relationships in your head. Remember, those relationships are stable until they're not. And the correlations are not 100% positive or negative on any of those. John Murphy would tell you that, and he wrote about that in his books on intermarket analysis. So don't oversimplify between them. Pay attention to the trends and see what you're seeing. Gold pushing higher in a way that seems relatively attractive there. Looking at a daily chart of the S&P 500, we talked last week about that 3,000 level. Last week was the week we broke above the 200-day moving average, broke above 3,000 for the first time since last March, or since March, a couple months ago. But then every day we tried to push higher, we retested that 3,000 level, retested the 200-day. Today, again, sort of pushing higher. This is the highest close we've had since the rally here out of the lows. We continue to chip away higher, and again, every day like this makes the a potential for a down we've seen less and less a reality. I think the other thing that's important to note is I've talked about the RSI being at 60 being a key indication of a bear market phase. We're now above that. So, if you are not buying into the potential for the S&P returning to the previous highs, I think you certainly need to consider the risk reward of that. What concerns me, again, with jumping to the rest of our update, is thinking about the potential for upside in different sectors. Technology particularly comes to mind. We've talked about that potential double topping pattern in healthcare and technology. So as the S&P going higher today, tech actually came on in the afternoon, but overall finishing flat for the day. It was down a little bit more earlier today. Healthcare down, was the only of the S&P sectors really down a meaningful amount, about 1%. So now you have tech and healthcare, the sectors that have pushed the market higher, now rotating a little bit lower, and on a relative basis, certainly starting to underperform a little bit. If you look at a chart of the XLV, here we're looking at it relative to the S&P 500. You can see how the relative strength really has broken down in the last couple of weeks. If you look at it relative to the XLK, it's even more concerning, a little more negative. And again, what I'm talking about, and it's not just with healthcare, it's also with the XLK, it's with Microsoft, it's with consumer names like Home Depot. They're sort of up against this key resistance from earlier in the year. A lot of them topped out in January. A lot of them saw their peak in February, but we're kind of there. We've sort of round tripped. And I think for the market to meaningfully go higher, for it to reach S&P 3,400 and retest the previous highs, you'd need to see sectors like healthcare and technology resume their uptrend and push to new highs. That's also going to affect that breadth reading we like to look at, which is looking at the new highs and new lows on the S&P 500. I'm sorry for jumping around a little bit, but this is the sort of macro thesis I've been thinking about over the weekend into today. Here are the stocks making new 52-week highs, new 52-week lows, and it's pretty compressed here on the S&P. You can see, 40 names, so it's almost 10% of the S&P that's starting to make new highs going into the end of last week, which is a meaningful number. That's up from zero not too long ago, just a week or two ago. So seeing that number increase, which would mean that tech healthcare names are starting, consumer names pushing above their previous highs, that'll see that indicator really start to increase, which tells you that leadership names are pushing higher. I don't know how much higher we could go, led by things like REITs, which is sort of what you saw on a day like today. Real estate up almost 2%, followed by energy and utilities. That's not sort of the traditional offense step on the accelerator. It's more of a defensive trade, to be honest with you. So some interesting rotations on sectors are going to rotate next and look at our sector setup. So I just want to highlight some of those some of those key ideas. What we're going to do for the remainder of the show, we're going to talk next about sector setups. We'll focus on the 11 S&P sectors. Then in a segment called Shifting Stocks, we'll focus a little bit on some of these groups and some of the individual stocks making up those groups and what movements we may want to be prepared for, what we want to be on the right side of. So for sector setups, let's start with the relative rotation graph, the RRG. And again, if you're not familiar with this, look at our chart school articles, look at Julius de Kempener's blog. He does a great job of explaining this methodology, but we're looking at the 11 sectors and how they rotate around the S&P right at the 0 point there in the middle. You can see, and it's sort of a little choppy, but these two hugging here on the right side are the XLK and the XLV. The XLV is what's rotated so strongly down from that leading quadrant, and this is the first time in months that it's actually been in the weakening quadrant, following consumer staples, which led the way down there previously. That's after utilities, real estate, all sort of rotating from a position of strength in the leading quadrant, now in a position of relative weakness, heading southwest, exiting that leading quadrant. The XLK stubbornly remaining in the leading quadrant, but it's right at that point where it's sort of testing it. So what is emerging more in a position of strength? Well, it's things like communication services, which is held up okay. Consumer discretionary, where you're seeing a lot of a big coming in. And it's not just from the leadership areas that had been leading up until now. It's also some of the beaten down groups like gambling, hotels, and others. We're going to look at some of those in a later segment. You'll see how some of them are actually really starting to improve, especially on a relative basis. Materials is here, the XLB, and gold stocks have been one of the stronger groups until recently. Stocks like Newmont Mining, and that in particular was one of the top-ranked scooter stocks for a while, rolled off the top 10 at the end of last week for the first time in a while, which is a bit of a change of character, but overall materials holding up very well. I think energy was the big unknown, and it was such an ignore over here on the far left side in the lagging quadrant, heading in the position of weakness for quite a while. Now has really improved and accelerated. And again, I've mentioned this improvement in the energy sector, especially on a relative basis. So I know it is very much a macro bet. You're betting on oil prices in a lot of ways, but again, focus on the trends, focus on the charts, and there are spots within energy that certainly have been relatively attractive. The real questions I think now, besides the sectors we mentioned, are down here: financials and industrials. Industrials, you have things like transports, railroads, airlines, which are groups that have just been disasters. But again, when they start to improve, they have these huge, 10+% up moves that you feel not so great about not being there based on some of the movements out of lows and financials, right? So the banks and others have been relative losers, but all of a sudden really starting to emerge. So I think those are the real questions. Those are where I'll be looking at to see if we get improvement in those. And again, financials as leadership has been so off of the list of things I would expect, but certainly has been starting to happen at times here. Let's look at the 11 S&P sectors here, zooming out using our candle glance function. It's a great way to sort of look at the 11 sectors all at once. Then we have the S&P at the bottom here. So at this point, what I like to think about is the S&P has now achieved its 200-day moving average. And we talked about the importance of that, the importance of the 3,000 level. I think you have to acknowledge that it's now broken above that. And the question is, what's next? And so which sectors have also been able to eclipse their 200-day moving average, remaining in a position of strength? You can see consumer discretionary, comm services, technology, all agreeing with that. Healthcare as well, but you can see the difference between communication services, consumer discretionary accelerating, healthcare really stabilizing, still increasing on a price basis. But again, the relative is what's so important. So here, as I mentioned, we're looking at the healthcare sector relative to the spiders, relative to technology, and it's just been, on a relative basis, it just hasn't been getting it done. So I think you want to look elsewhere where there have been upswings, and in those previous sectors, we've certainly seen it. We then have a handful of sectors testing their 200-day moving average right now. And it's sort of a mix of traditional defensive things like consumer staples testing right there with the XLP right at the 60 level, which was a previous high from April. Also the 200-day, so a really important level that it's testing on a price basis. Same thing pretty much with utilities. Real estate's a little below its 200-day, but still testing resistance. So you have a handful of sectors like that right up against key resistance levels, which I think will be important to watch. Materials just breaking above its 200-day, still testing it. Which is an interesting one. Again, gold stocks have been pretty powerful there. Then we have financials and we have energy, and those are sort of like the other bucket. Financials have broken above their swing high. The XLF has broken above that high from April. However, we sort of saw distribution right after that. So the big breakout that we saw into the middle point of last week, again, a shortened holiday week, that's when all this happened. And then Friday kind of came off a little bit. Today up a little, but still, sort of overall, I think still there's a question as to whether it's following through to the upside or not. On a relative basis, potentially hooking higher here. And I think that'll be an interesting thing to see. Again, if that starts to emerge, I know a lot of people have gotten away from a position in financials, and you may want to be looking at opportunities there. And then energy is the last one that I think is a question, industrials as well. They're sort of the three sectors that are improving on a price basis, but still, well below their 200-day, have not anywhere near eclipsed that. Energy's actually been flat on a relative basis. If you look at the last 3 to 4 weeks, had the big run, and most of the relative gains came out of that 6 weeks after the March low. Since then, it's sort of been a market performer as other sectors have caught up and have done just fine. So if you haven't been there yet, I think you want to wait to see if there's further improvement before you assume that there's a lot more upside in some of those. And then, as I mentioned before, I think one of the big sector themes to pay attention to, the consistent outperformance of technology has been such a key theme. It's come off just a little bit in the last couple of weeks, but overall the trend has been positive. The long-term relative trend continues to impress. I think for me, I'm looking at that 102 level, and from a risk reward perspective, what concerns me is limited upside and the potential for a lot of downside, right? Even just thinking of a pullback to the 200-day, that takes it all the way back to around 87. If it would happen relatively quickly, that's down from 97. So you have 5 points higher and 10 points lower, and that doesn't tend to be a good risk reward relationship. But again, if the relative strength continues to improve, it tells you it's a better bet than average. So I think you're looking at where it's at relative to these key resistance levels. Are sectors like tech and healthcare able to push through, especially some of those key groups like semiconductors and others? Let's take a quick commercial break. Back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. As a reminder, we love to answer your questions in the Final Bar mailbag. Shoot us an email anytime, thefinalbar@StockCharts.com. Let us know what charts you're looking at, what questions you have. And it could be on price analysis, technical indicators, but also market history, market structure, whatever you're running into that you'd like to get some help figuring out. We're here to help empower you to make better decisions using the power of technical analysis, the power of data visualization. So please help us help you along on this journey, and just let us know what you need. The Final Bar at StockCharts.com. Just send us a question, and I'd love to answer it on the air tomorrow. Our next segment is called Shifting Stocks. So now we've continued this process as part of my weekly routine that starts on Friday, continues through Sunday night. Is looking at the market from three perspectives: the top-down macro, the sector rotation, and the bottom-up stock picking. And I will tell you, certain weeks it is tempting to skip one or a couple of those just for priorities and doing other things. And I found the more I stick to that as a discipline, the better equipped I am to understand market movements. And especially this last one, looking at hundreds of individual stock charts can be a bit overwhelming at times, and I've struggled sometimes to figure out where to plan that into to my days, my week. But I will tell you, I feel a much deeper understanding of the market dynamics. Looking at breadth is a good proxy for that, but there is no substitute for looking at individual stocks, especially if you want to think about a sector in a little more detail. And that's kind of what I wanted to do today. I'm going to use our industry summary page. And if you're not familiar with that, just click on Charts and Tools up in the Stock Charts header. You'll see a selection for the industry summary. What that does is it breaks down the 11 S&P sectors, and we link them to some of the industry groups that are going to help you understand the breakdown a little further. What I like to do is sort it based on the scooter rankings. So this is based on the Stock Charts technical rating, and this is just for all the industries. So this is a percentile ranking for each industry within the sectors, and it helps you understand just where the movements are. What I want to do is just hit on a couple of the groups here at the top of the list, the top performers within consumer discretionary, because this is a sector that's really started to emerge as a relative outperformer. I just want to focus on some of the groups getting it done, but also look at some of these others that are lower in the scooter rankings, like hotels, but actually starting to improve a little bit and maybe worth paying your attention to, especially if you've written them off mentally because of how much they got crushed in recent months. Let's start with the number one group. This is the automobiles industry group. And if you click on automobiles, if you sort it by the scooter rankings, you're going to see a familiar name up here at the top. Now, when you use this function, it's mixing all of them together. So it's not just large caps, it's mid caps, small caps, unlisted or ones that are outside of our scooter rankings, all will appear on this list. So it's a good way to just see where the leadership is. And within most industries, you'll see there's quite a spread. So here within the automobiles industry, you have something like Tesla that's been a strong performer. You have something like a Hog there at the bottom of the list that's really been hurt on a relative basis, although it came on pretty well here today. Looking at a chart of Tesla, this is a great actual technical lesson. If you look at Tesla, you can see the previous high here around 950 or so, and it tested it in early February, retested that in mid-February, came off and hit the 200-day. And this is a great use of the 200-day moving average. It hit it, and beautifully bounced right back up, and now has round tripped essentially back to those previous highs. 950 is that key resistance level. From there, you can see the gap down, or sort of the engulfing pattern we saw here at the end of April when it pulled back a little bit, but since then has once again recovered and up 7.5% today, pushing it just to the overbought level as it pushed higher. The reason why this is a great example stock to look at is I think if you get too caught up in just the analysis of the price, you're missing the magnitude of some of these gains. So if you look at the bottom, you can see over the last year, Tesla's actually outperformed the S&P by over 300% on a relative basis. So even though the price looks similar to a lot of other price patterns you've looked at, the relative strength line really tells the story of the magnitude of returns you're getting on a stock like this that's done well on a relative basis versus other ones that are just sort of chipping away at a consistent uptrend. So overall, the trend has been in a pretty positive place. At the overbought condition, which essentially means it's gone up a lot. You saw back here in October, December, January of last year, it became overbought and remained overbought for quite a while as the returns sort of accelerated. So I think right now you're nearing that potential pattern to see whether we have this extended overbought condition. Usually you'd expect a bit of a pullback when something starts to get into that overbought region. It's sort of on a pullback watch. But overall, as long as the trend persists, higher highs, higher lows, the trend is in pretty decent shape there. So that's Tesla, which is really the top ranked stock in that group. Down at the bottom, you have something like Harley Davidson, which again doesn't look horrible if you look at the price. Higher highs, higher lows, and that trend is actually continued. So even with all the relative movements, all the uncertainty, keeps putting in a higher low. Right now, 21 is a good short-term, sort of risk level or a stop loss to a long position. That's the low from last Friday after a bit of a pullback. Potential good risk reward, especially in the short term, leading up to those previous highs. If that trend would continue, and a relatively tight stop would limit potential losses there. So Hog's an interesting one. The traditional automakers are not my favorite companies in the world, but the charts aren't bad. On a relative basis, you can see coming out of a relatively beaten down level there, hit relative lows in March, held, with the rest of the market through the beginning of May, but then starting to improve a little bit. And again, breaking above the resistance from April, pulling back into Friday, but bouncing a little bit. And again, right now I see it's a chart with higher highs and higher lows, which overall fairly attractive. So some of these names, especially automobiles, pulled back last week, potentially if that uptrend continues, and use the previous lows, the previous swing lows as a risk level or as a stop of sorts. I think it could be in for an interesting potential ride there. I wanted to just hit on home builders because that's something that people have been asking about. There are a lot of names in here that look relatively similar. We'll pick D.R. Horton, but Lennar and others are kind of interesting. These, I think a lot of them, you're looking at the 200-day moving average. DHI in particular is one that hit the 200-day first week in May, pulled back, now has continued through it, had the bearish engulfing pattern last week, and since then has pulled off a little bit. So the short-term pattern a little weaker. This is coming out of an overbought reading as well. So, a stock that's overbought with a bearish engulfing pattern tends to be a pretty good bet for at least a short-term pullback. And I think that's what we're in the middle of. from there, it's where we at relative to these previous swing lows. And unfortunately for something like DR Horton, you've got support back here around 44. That's a long way from now. So I think the 200-day, which is the gap here from mid-May, might be a more reasonable level to look for some sort of pullback. But then we have these huge, the February highs to contend with. So I think with home builders, that's one of those groups within consumer discretionary that rallied pretty well, but now you're at risk of testing that big resistance. When again, it can eclipse that. The question is whether it's able to. I also want to just point out some of these groups that are a little more beaten down. So if you look at something like hotels, sorted on the Scooter rankings, some of these charts have actually run up really nicely. And I feel like groups like this, it's like when we weren't looking, right? Something like Wyndham Hotels, WH. If you look here, and just to quick point out, I'm so excited to let you know we've added market cap in the full quote region on the price chart. So if you had the full quote, you'll get the market cap. So it's a $4.5 billion cap company. Retesting the 200-day on a relative basis, it had been down here, 50% down since June of last year. That's come up to still down about 17.5%, but that's gained 30% back since that sell-off in March. Now testing the 200 days. So I think for something like Wyndham, it's at a really, really key point here. This is a little bit earlier from what the S&P is now, or is testing the 200-day. The question is whether it's able to break through on it. But again, since the March lows, if you look pretty consistently, higher highs, higher lows, nice consistent performer. And again, just the price continues to go higher. So as much as we speculate as to what should work, what could work in some of these groups, I think you're best off looking at what is working and look at the price charts. Finally, I just want to hit on Hilton. And again, the hotels group, I think, has so many potential challenges with so much uncertainty. But again, just in terms of the price, you have to acknowledge that these things have been in pretty good uptrends. A lot of them pulled back into last week and now potentially establishing a higher low up today. And we'll see if that's able to continue. And I think on a relative basis, something like Hilton, the question is it's able to continue to make relative highs. But overall, I think the trend is aiming in the right direction. So that's all we can do with this section on shifting stocks. Again, I would encourage you to spend some time with the industry summary page. It's a great way to think about a sector, especially one like consumer discretionary, that you recognize the outperformance and look at how some of these different groups are setting up. Some of them potentially at more viable points, pulling back a little bit within longer term uptrends, and overall that tends to be, I think, a better approach in general. We need to wrap the show, go right to the 3 and 3 charts, 3 minutes. Here we go. First off is the dollar bullish ETF, the UUP. You can use the dollar index as well, but I tend to start with the UUP just because the looking at the short-term movements is pretty key. The UUP is actually just breaking down through its 200-day moving average today. The RSI is now below that key 40 level. So essentially what's happened is this: since the real volatile period there in March, since it settled down, you've had a series of lower highs. The RSI never really got above 60. It's now broken below 40, which now confirms, and with the break below the 200-day, the dollar is in at least a short-term downtrend for sure. Breaking down through support, breaking down through moving averages, RSI getting in that oversold area, or being more in a bearish region. So the dollar certainly more in a cyclical downtrend. If you look at the relative performance of the S&P versus ACWI, so this is looking at the US versus the entire global equity market, you can see it's also making a new swing low, breaking below the relative lows from the second week in May. So now you have the US starting to underperform the world. And again, a lot of that is based off of that dollar weakness. That idea of dollar weakness, US underperformance, again, we've talked about that in some of these previous pullbacks. I think that's an area that a lot of people are underprepared for. It might be an interesting time to think about your international allocation and think about, what would happen if we continue to see this weakness. If US stocks continue to underperform, could be a good opportunity to benefit from having some international exposure you probably have not thought about. And then finally, sectors like utilities starting to pop a little bit. I think it's interesting to see if groups like this are able to accomplish their 200-day moving average. Whether or not that happens, I think will be interesting to see for sure. Folks, that's our show today. Thanks for going on this macro, micro, and everything in between journey with us on a Monday afternoon. As a reminder, we have some really good guests coming on the rest of this week, so I hope you'll join us there as well. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.